If you're considering getting into real estate and you want to be a passive investor, if you want to be the passive side of a partnership, then this is the video for you. I interview my father, who's my passive partner, and we go over everything from what it's like to invest with family, how we set up our LLC, all the way down to how we split the equity in the properties that we own. And most importantly, at the end of the video, we share our 3 C's on how to pick the perfect partner. All of that and more in this episode of Investing in Bryan-College Station, where we go over everything about growing your wealth in our favorite towns of Bryan and College Station, Texas. I hope you like, subscribe, and enjoy this episode. And hey, real quick, if you are an active investor, don't worry. I'll have a video for you specifically here shortly from my point of view as the guy hustling and grinding his way through this real estate game. If you've got a burning question or you just want to reach out, all my contact information is in the details below. A quick background so that you understand the context of the interview. I'm interviewing my father, who's the passive side of our partnership. He lives and works in Maryland, so he's also an out-of-state investor. He's very busy running a very successful nonprofit, whereas I am living in Bryan-College Station, and I'm the active side of our partnership. I'm an active full-time real estate agent, and I also manage our entire portfolio, which has grown from just a duplex in 2018 all the way up to 19 units today, where our entire portfolio is right here in town.
What is the difference between a debt partner and an equity partner, and why did we, and ultimately from your perspective, choose to set up our partnership the way we did?
Sure. So a debt partner is very much like a bank loan, right? So it's somebody that's going to provide funding for a purchase. They're looking for more of an immediate return,
Okay.
potentially some percent return on the money that they're providing. It's more of a short-term deal, lower risk because of their guaranteed, to a certain extent, their payback.
Okay.
Although if the deal goes bad, if the loan goes belly up, the organization goes belly up, they would lose their funding that way. On the equity side is more of an investment, if you will, right? The investment side of the business. So an equity partner is looking more for a long-term return, looking for a greater upside, but is also taking more risk. So no different than in any other type of investment where there's always risk return. So as an equity partner, you're always looking at that risk of potentially losing your money.
So why was it for us that you chose to go with the equity side, or from your perspective, why is that better for your situation? And who or what kind of situation is ideal maybe for that side? Person in life or within the kind of real estate realm?
Yeah, I think it's, again, it runs to risk to a certain extent. That debt partner is somebody that doesn't want to take the long-term risk, maybe isn't in it for the long term. Where on my end, I was looking for more of a long-term setup between you and I,
Right.
where when I get to retirement, I'm going to be able to generate that passive income that I can have that will be long-standing, right? So as an equity partner, I'm going to be looking at a return year over year over year, where that debt partner is really looking at a short term, and then there's an end to that investment.
Worth noting also that a debt partner, usually like a bank, has a fixed income. If inflation continues the way it has, we've seen a lot of that recently, you have a hedge against that, whereas a debt partner might not, right?
Absolutely, yeah. So, the properties that we purchase, they're going to appreciate with inflation. They're going to appreciate with value over time.
Right.
Rents are going to go up over time. So, the goal is to generate that ongoing percent return over and above the inflation. Right. So that's the value of being an equity partner.
Cool. So our next question, basically, so now we've determined, obviously, this is an equity partnership. And the standard thought is, okay, so if I'm going to start with a partner, it's going to be 50-50. That's not necessarily how we set up our structure. So how did we, and what do you think about when you're determining a split within partnerships? And what factors should be considered when you're determining who gets what in that structure, that setup?
Right. So my partner here gets most of the return because he's the most important.
Yeah.
Right, Chance, you're the most
most
important
passive.
part of this.
He's the most passive.
He is
partner.
well, not always the most passive partner. But yeah, so when we looking at the partnership, and when we first launched this thing years ago, we set it up, and we learned a lot from that first investment, which was awesome.
Right.
I mean, and I think that
was purely 50-50. 50% of the money in and the ownership.
That's right.
Right.
And the difference is that we had to go out and find a third party to handle the property, right? The
And
property
the
management team, and so they got a percent of that. As we learned from that, there's a huge value in having you and your wife and your organization manage the property.
Right.
And so when we looked at how are we going to do the split, it had a lot to do with the fact that you guys were going to manage the property, which was going to reduce the risk on vacancies. It was going to reduce the risk on issues with the property because you were right there to take care of things. It made switching over to Airbnb much easier because we were able to do that. So as we looked at the percentage, I was the financial partner, right? And so I put in more of the financial side, but you reduced my risk by being the management team that was going to manage the property. And I mean, not only was it just because you're my son, but I had confidence in the fact that you knew what you were doing. You had worked for a management team before. You had tremendous experience. I know what your drive is. I know what your focus is. Because if that wasn't there, father-son would be great, but we wouldn't be partners in business.
Yep. So for just anyone out there viewing who's kind of figuring out how the structure is set up, we don't bring equal equity or initial capital to the purchase, but our equity is split, our cash flow is split, and anytime we sell a property, we get made even based on what we put in. Anything after that is then split, where I'm bringing in a lot of experience, and that's a lot of the value I bring in. On your partnership side, the value you bring in is literally the value, the money, in a lot of cases. But that being said, I still have skin in the game. And that's something that's, I think, very important to us, is that in everything we buy, we're both going to put skin in the game.
And I think people need to understand that you got to be careful jumping into business with family. I've done it before, and it hasn't worked well. And so, a big piece of that was when we went into this, we laid out expectations. We laid out the requirements early on. We both knew what was expected of the other when they got into it.
In writing.
Right. Absolutely. And so it was signed. It's a legal document, and that makes a big difference. So if you're going to go into business with family, you really want to make that and put that out there in the front part of the agreement. Make it a legal document. Make it a business, because things go wrong in business that put stress on family. And if you do that ahead of time, it assures that the family stays on this side and the business stays on that side. And you really never want to mix the two.
We talked a little bit about the fact that we have a written agreement in this partnership. We run it like a business. But a question that comes up a lot is, if I'm going to partner with somebody, do I need to set up an LLC? Ultimately, we did end up setting an LLC. We didn't quite do it the way we wanted to on the first property. And now once we got things up and running, we very specifically have the business LLC. So let's talk about why it was important initially to have the LLC as the legal structure behind our partnership. Because we could have just signed a piece of paper and been partners.
And I think that, everybody, it's different for everybody. And so I think you have to look at, there's a variety of different business structures you could create out there, whether it's an LLC or which is a legal liability corporation. But it basically gives you some protection against someone who wants to sue the organization. And so they can't get to the individuals. And that's really why you want to set up an LLC. But for us, it also created a legal organization, again, separating kind of business from family, which is really important. And it protected me, obviously, as an investor on the equity side, that I wanted to make sure, because look, you do a great job, but if you get in business with somebody that doesn't do a great job and you're an equity partner, you really don't have any control over how they're handling the business.
Right.
So having an LLC protects me as the investor if in fact you do something that causes the organization to have some sort of liability or legal liability.
Right. And so similarly, one, the LLC separates your other assets from these assets, right? It provides a legal structure for us to have a business, and even if it's just the mental side of it, of we have this business. It is Schwartz Family Realty LLC. It is a thing. We talk about it as a separate entity, not just the relationship, but the business. But two, we created a property management company that has the relationship with the LLC. So again, it takes the personal side out of it so that we can still have the relationship we have without mucking it up with the business side of everything. So it can almost be a whole separate
Absolutely. Absolutely. And, and we talked a little bit about, keeping family out of it. But, part of it is being able to do business with family, right? I mean, it's exciting. It's neat to be able to continue that, to help you grow your business.
Yeah.
And as I get to retirement age, maybe there's ways that I can be more involved with, some doing the work in some of the facilities and those types of things, which would be fun. So for those of you that are thinking about, partnering with parents or grandparents or aunts and uncles, there is that side of it. It's exciting. It's fun to be in business with family.
Right. Some of the downsides for folks out there, call them downsides, but some of the things to think about with an LLC, we found out is we created the LLC and then we bought the first property in my name. Right. And that became interesting when I am getting tax write-offs from a property that I own that your name wasn't on, but the LLC, we had this LLC agreement, it just wasn't done right and wasn't clean. And I really like to keep things simple.
Right.
So that was very complicated, and I'm not a very smart guy, and it got too far removed from my ability to understand how taxes are going to work out and everything else. So going forward, when we started buying in Texas, we created the LLC, and then the LLC bought all the properties, which means we had to use a commercial loan. So it's a different loan product. It's not as advantageous as a personal loan, but it kept everything real neat and clean within the LLC.
Right.
And then, of course, the LLC will have a tax return. It's going to provide K-1s to us based on the tax advantages, the pass-throughs, the losses, all those kind of things that you have in real estate gets passed through the LLC and then passed to us via the K-1. So there are some things with the LLC that can seem more difficult or off-putting, but for us it simplified it a lot and honestly was an overall major advantage relative to the complexities of owning it in my name and we're a partner and we have this LLC together and we had an LLC in North Carolina, a property in Alabama, and now we keep everything in Texas, and it simplified it a lot. So
yeah, I agree. I think that, for me, from the investor side, the protection from potential
primary
lawsuits or something was the number one primary reason.
Right. And that is literally limited liability corporation. That is why it exists. Separate you from your own.
Yep.
All right. So it's not all sunshine and rainbows. Mostly. I mean, things are going pretty good, but as a passive partner, there's advantages and disadvantages. So from my perspective as an active partner, it's very different. So I want to know from you as the more passive side of things. And I would say passive-ish. It's not like you just sign a check and then you don't hear anything. And you have decisions and big stuff, but just from your perspective, advantages, disadvantages, and kind of how it's worked out for you. Also keep in mind that you're in Maryland and all of our properties are here in Texas.
Sure. And so, when we talked about this, I didn't want to be an active partner, right? I run a business. I have plenty to do in running that business. I don't want to run another business.
Right.
And so the key is the fact that I trusted you to be able to run the business the way I would run it.
Right.
And I think that that's the value for me is, being out of state, we're investing in Texas where the real estate. Would this work if we were investing in Delaware or in Pennsylvania? Maybe not, because for me, it was okay to be passive, knowing that you were here and that you were in control of things. I like to have control, and if I don't have control, then I need my partner to have control. And so, by you having control, I'm able to sit back and look at the investment. I get to come down to Texas on a regular basis, a couple times a year, look at the properties, see what they look like. We talk about what might be needed in the future and those types of things. And even then, I still leave most of those decisions up to you. That's what I was looking for. I was looking to invest my money. And I think for the most part, my guess is that most investors are looking for that type of opportunity, right? So some other folks that I've talked to about potentially investing with you, they want somebody that's going to oversee the property. They don't want to be involved. They just want to know that they've got somebody they can trust. And that's a big deal. I mean, trust is huge. I mean, you got to be able to have a partner that you can trust, that you're willing to let them do their thing.
So that segues real perfectly into our last question. And ultimately, if someone's out there, they are looking to invest and they think they're going to be more on the passive side of things, like yourself, they're busy, they've got some level of retirement saved up, maybe they want to diversify into real estate. What would you say would be your top 3 or 4 things that someone should look out for in terms of evaluating that active side of the partnership?
Yeah, I think it's a lot like hiring somebody, right? If you run a business and you're hiring people, the first thing you want to do, and again, does that partner fit the core values that you want to have, right? So, to me, it's important that we take care of our customer, or that you take care of our customer. I want our customer to be treated with dignity and, with a sense of responsibility to their needs. And so that was important to me that you were going to do that. It was important to me that I had somebody that I could trust, because you handle the money, you handle the rent, you handle all those things. I've had a situation in my own business where I had an accountant that I couldn't trust, and so it's difficult when you're out of state, you're not right there, you don't look at the books on a regular basis, and you can do some of those things as a passive investor if you want, right? But being an accountant, I know that there's ways that you can get around that. So I think trust is a huge piece of it. And then, do they know what they're doing? So very much like hiring somebody. And as we got into it, it's, again, it's the same philosophy I have in my business, where when I hire somebody, I hire them because they fit the core values of the organization. I know I can trust them. I know they have the skills necessary to do what they need to do, and then I let them go do it. Right? I don't oversee what they're doing. I don't micromanage. I want to make sure that they're good to go to go do the business. And I think those are the 3 real keys.
The 3 C's of partnership?
The 3 C's.
We said core values, character, trust, and competency. The 3 C's of partnership.
There you go.
So the 3 C's, your big takeaway, if you're looking for this kind of stuff, if you're looking for an active partner, you heard it here, the 3 C's of finding a partner. What do we say again?
Competency.
Competency.
It's not an easy word to say.
Character, aka can you trust them? And do they have your same core values?